Two major headlines dominated markets yesterday. First, the United Arab Emirates announced that it is leaving OPEC after 6 decades, driven by frustration with production quotas and ongoing tensions with Saudi Arabia. And second, the Wall Street Journal reported that OpenAI missed several internal targets for revenue and user growth for months, a warning sign for an ecosystem worth hundreds of billions of US dollars. So the Nasdaq 100 fell 1% yesterday while oil prices kept rising. Later today, the Fed will announce its latest monetary policy decision, and big technology names will be reporting their earnings after the bell as well. So let's see if they can keep investors in the mood. So welcome to Swissquote's Daily Market Talk. It's Wednesday, April 29th. I'm İpek Özkardeşkaya, and everything I say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So we had two big headlines yesterday, no Trump related, hallelujah. And these were: one, Wall Street Journal reporting that OpenAI missed several monthly internal targets for new users and revenue. And two, the United Arab Emirates is leaving OPEC. Now, it was hard to choose which one to start with, but there you go. I start with the UAE news. So the UAE is leaving OPEC after 6 decades. Yes, they want to follow their own oil strategy. They don't want to be constricted by OPEC's production quotas. They have had arguments about this before with Saudi Arabia, and they apparently thought that the Middle East disruption was the right time to take the step. Now, what's important to know here is that the UAE stood for around 12% of OPEC's total production and will sure have an impact on the punch power of OPEC globally. OPEC, on the other hand, accounts for about 35 to 40% of the global market share for oil. And without the UAE, this market share would drop to 31 to 36%. It ultimately means that OPEC's output restrictions would have a smaller impact on stabilizing global oil prices or keeping them supported. And worse, the UAE's departure from OPEC could also encourage other producers to pursue their own national interests alone. And that would mean maximizing production to maximize revenue in a context where smaller production can no longer give enough support to oil prices globally to make the oil restricting strategies fructuous enough. In short, higher competition among oil producers and more supply will likely weigh on medium to long-term oil prices when the Middle East settles and trade via the Strait of Hormuz is restored. But in the short run, and given the massive disruption to oil flows through the strait, well, the decision will have a limited impact on oil prices because the geopolitical tensions weigh much heavier today, and the oil market is under supply due to the nearly complete halt of oil flows to the global markets due to the closure of the Strait of Hormuz, and the UAE cannot bring barrels to the market even if they wanted to do so. This is exactly why the oil prices rose yesterday despite the UAE news. Both US and Brent crude traded past the $105 per barrel level, and the longer dated oil futures rose as well, though they rose less than the shorter dated ones, hinting that the UAE news have indeed got diluted by the highly intense geopolitical context. And unsurprisingly, higher oil prices didn't enchant equity investors around the world, but the real hit to equity sentiment was indeed the news that OpenAI missed internal targets on revenue and user growth, suggesting that the revenue growth may not be enough at OpenAI to meet the future and lofty competing contracts. In other words, OpenAI may just miss on their future payments if they cannot pull enough money in. Now, a startup not meeting internal targets could have been a minor problem for global financial markets if it was not sitting in the middle of hundreds of billion US dollars of a complex web of AI circular deals that actually includes the world's biggest and amply valued names. I think of Nvidia here, down around 1.60% in yesterday's trading session, AMD down 3.40%, Oracle down by more than 4% yesterday, and SoftBank down nearly 10%. Microsoft, on the other hand, rebounded 1% yesterday after having announced a day earlier that they are relaxing their ties with the company. Now, the reason why OpenAI missed its targets is likely the emergence of Google's Gemini and Anthropic's Claude models that came to challenge OpenAI, especially in the lucrative coding business. They simply took a share of the OpenAI's revenue. And indeed, since last October, Anthropic-related stocks did notably better than the OpenAI-related ones. Now, of course, the circles overlap with some big companies finding themselves in the intersection of these two circles, like Nvidia and AMD. But Google and Amazon, for example, have been strongly backing Anthropic since recently, while Oracle and Microsoft were among the major names in the OpenAI circle. So what's next? While OpenAI news impacted Google and Amazon less than they did the companies heavily betting on OpenAI. And yes, I'm looking at you, SoftBank. Well, the risk of slowing revenue growth due to intense and intensifying competition among AI models could and probably will become a headache for other AI models and other AI model providers, as well as scaling is costly, and again, competition is extremely intense. The latter should have a limited impact on chip and computing demand, but the companies must navigate their revenue potential and risk from these AI companies, from these individual companies more carefully, because if OpenAI, for example, misses a payment, well, there will be a domino effect across the line. And that is the worst case scenario for the AI rally and could have global implications. And these implications wouldn't be great. But anyway, this morning, the futures in the US are pointing at a positive start, suggesting that the market has already absorbed the OpenAI news and just decided to ignore them. On the other hand, the Federal Reserve will be in focus today, along with earnings from Google, Microsoft, Meta, and Qualcomm. They are due after the closing bell in the US. The US big technology names are expected to print a 40% revenue growth on average for last quarter, slowing but still very strong. And for the rest of the S&P 500 companies, 80% of these companies that already reported earnings will beat revenue expectations so far. Across the Atlantic Ocean, the picture is more mixed, however. Barclays, for example, fell short of the US rivals in first quarter results, while BP gained around 1% yesterday after confirming that the Middle East volatility led to profit growth. But overall, appetite in European equities is waning, and that's due to rising energy costs and deteriorating growth prospects. Meanwhile, the 12-month inflation expectations for the euro area spiked to 4%, a spike that could eventually encourage workers to ask for higher salaries and companies to pass these additional energy costs onto their clients, and the latter would lead to a fresh inflation spiral in the euro area that could oblige the European Central Bank to tighten its monetary policy by hiking the interest rates. Now, the ECB is expected to stay pat when it announces latest policy verdict tomorrow, but the benchmark for 10-year euro area government yield is painting a worrying picture. On the FX front, the euro-dollar remains under pressure despite the hawkish news for the European Central Bank. The pair has been testing the 200-day moving average indeed due to the less hawkish ECB expectations recently, and that's due to the deteriorating growth prospects for the euro area, which may somehow convince the European Central Bank that hiking the interest rates roughly would not be a good idea. And there is also the broad US dollar story that is having an impact on the euro dollar's pricing these days, because the US dollar is gaining field again these days on the back of tense geopolitical environment in the Middle East that is leading to rising oil prices again. And rising oil prices simply mean rising demand for US dollars because oil is negotiated in terms of US dollars in the international markets. But at some point, the hawkish divergence from the European Central Bank could eventually bring the euro bulls in. But for now, well, we must see oil prices stabilize, and that's unfortunately not on the menu du jour. But who knows? So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.